All right, so time value of money. As you guys saw on Tuesday, it's a pretty technical topic in terms of the calculations and stuff. It does build to being a little more useful, and we'll use the machinery a little bit as we kind of proceed into the course. But I do want to kind of just let you guys know this part is very computationally heavy. So do bear with me for this part, and we will do something a little more exciting as we get on with the course. One other thing, I will jump back and forth between this and the financial calculator app here. In class the other day, the document cam wasn't working, so I couldn't show you guys the financial calculator as I was kind of doing the computations, which is not super helpful. So it will be nice to be able to kind of flip back and forth here, and hopefully the doc cam will be fixed by this coming Tuesday. So financial decisions, as we said, there's this component that financial managers need to worry about that has to do with making trade-offs across time. And then there's also the risk component that we talked about. We'll worry about the risk later. For now, we're going to worry about the trade-offs across time. So you can imagine that you've got some money today, say you're saving for retirement, and you don't need it right now. You're still working. You still get your salary. You don't need that spending in this moment. Instead, you need that spending in the future. You need to be able to spend money when you're 65, not when you're 35. And so what you would like to do is trade your current money for more future money. In fact, you would like to trade it for so much future money that you would be able to spend at some level until you die. It's kind of the idea of retirement savings. If you want to have some left over, just like give to your children or whatever, that's fine too. But essentially what you're trying to do is fund future spending. And so this trade-off decision gets made at a personal level just as much as it does at a business level. You can imagine for a business that you believe that if you were to expand your business into a new industry, that industry will result in some future profits. And so it's up to the financial managers to determine whether those expected future profits are worth the trade-off of giving up cash today. You've got $1 million, you want to put it into some new business line. That new business line needs to pay you something that is equivalent or more to $1 million in tomorrow's terms. That is to say, tomorrow's $1 million is not good enough. You could have $1 million today if you just waited. Instead, what you need is something that, given tomorrow's valuation, is equal to or greater than $1 million today. So that's what we mean when we talk about trade-offs across time. Essentially, a bank will never make you a loan if they believe that all of the future payments you make are worth less today than the money that they would have given you to buy the house. So from their perspective, they believe it's worth it for you to receive some money to go buy a house and for them to be compensated at some fixed interest rate, say 4% on a mortgage these days. That 4% more than compensates them for the trade-off of using up that cash right now. That's the highest and best use they have for that capital. So the simple example, not worrying about mortgages or business expansions just yet, is a single dollar value. Would you be willing to give me $100 today in exchange for $110 1 year from now? And so again, it's a classic example, $100, 110 thing. When it's these small dollar values, it's a little harder to say. But let's just kind of imagine that's $1 million and 1,100,000 or something like that. You can amplify this so that it makes it a little more real to you. But the basic idea here is, would you be willing to invest $100 today in exchange for $110 in 1 year? You can't just look at the two numbers. I mean, you can. Individually, you can decide your own preferences. But without some sort of systematic approach, there's no way to say for sure whether, on average, this is a deal you would take. You can't just say, well, yeah, $110 is worth more than $100, so I'm going to take that deal every day. Because what if you could invest, instead of this deal that I'm offering you, what if you could invest in another opportunity that would give you $120? Then I would be a terrible option. But if your alternative out there is only 5%, if the alternatives that are available would only give you $105 tomorrow, then this deal is much better. So we can't just look at the $2 values in isolation, because we need to consider what the foregone opportunities were, what the cost of giving it to me instead of giving it to someone else would be. So before we can kind of compare or combine these cash flows, we need to find equivalent values at the same point in time. And we need some coordinating interest rate to do that. We need some assessment of risk that's going to be a uniform way to value various projects or various investments or various cash flows. So what we want to do, instead of thinking about $100 today and $110 1 year from now, is to figure out what today's value of that $110 cash flow tomorrow might be. So there are two ways we can do this. What I just described is figuring out what we're going to call the present value, the PV, of this $110 cash flow. Or we could figure out the future value, the FV. We could figure out the future value of the current $100 cash flow. And so that's what's written down here at the bottom. We can move cash forward in time, say to next year, using what we're going to call a future value calculation, FV. Or we can move cash back in time to today using what we'll call present values, or PV. And so this is kind of the setup that I have for you guys. We'll talk about a single cash flow first. Essentially, how do you think about a single cash flow? How do we move it into the future? How do we move future cash flows into the present? We'll talk about the idea of how you deal with other kind of cash flow streams. So complex cash flows that aren't the same or that occur for a weird period of time. Annuities, which are a fixed number of payments and the payment's always the same. A perpetuity, where the payments are always the same, but it goes on forever. Then we'll talk about a few other topics like interest rates, how we adapt interest rates for variability in how often the interest gets paid. Calculating other values, so how do we determine the, say, payment on a mortgage, given the amount of the principal, the term of the mortgage that we've decided, the, say, 30 years, the 4% interest rate, and $1 million mortgage. How do we determine what the payment will be? Or, if I tell you the payment on that mortgage is $5,000, how long must the mortgage be? Ignoring the fact that I said 30 years a second ago, if we know it's $1 million mortgage, the payment's $5,000, the interest rate's 4%, how long must that mortgage be going for the bank to be okay with making that loan, for that to be a good deal? And then we'll talk a little bit about loan amortization, which is really just a useful life skill. There's nothing you really need to know for that until we get back into the bond stuff. But just from kind of a practical life skill part, it's one really easy way to see the day-to-day value of time value of money. Okay, so we talked about a few definitions last time, but just to kind of go back over the symbols, PV means present value, FV means future value. I, sometimes it's R, sometimes it'll be RE for our purposes, sometimes it'll be RD. Essentially, it's an interest rate. It won't get too confusing, I promise. When there's a distinction, when there's something important to know, it'll be very clear from the context of the discussion. But for a lot of times, we'll do I or we'll do R. And then N is going to be the number of time periods. Whether it's capital, lowercase, not super important. When we have a value, say X at time T, that refers to the period we're standing in. So if you think about a timeline, and we've got time 0, which is today, we've got time 1, time 2, times 3, and so on. Then we would have, this would be cash flow, let's say X at time 1, X at time 2, X at time 3. So that's all that subscript T thing is doing. And that's what I have here. So the cash flow at period T. I had it as X, but CF works the same. PMT, you'll notice doesn't have a subscript. Cash flow at T has a subscript because it tells you the cash flow at a particular point in time. But remember, with an annuity or a perpetuity, I said the payment is always the same. The cash flow is always the same. So CF1 is equal to CF2. The cash flow in each period is always going to be the same, so we don't need to call it CF subscript T, we just call it the payment. And you'll see on your financial calculator that it's also referred to as the payment. Okay, these interest factor things we'll worry about when we come back to them, but essentially it's just the thing you multiply to get whichever thing it is we're caring about. So for example, This is the future value interest factor. So we will take some cash flow and we'll multiply it by the future value interest factor to get the future value. We will take whatever the cash flow is times the present value interest factor to get the present value. If we're looking at an annuity, then we don't do these cash flows. We will take the payment, which will always be the same value, and multiply it by the future value interest factor for an annuity, and it'll give us the future value of the entire annuity. This future value interest factor will value the entire stream of cash flows. It will already have the fact that there are some number of payments at some interest rate. It'll already have all of that baked in. And same thing here with the present value, it will already have the number of payments baked in. So this is the calculator. I just pulled the screenshot off the internet, but essentially we're going to deal with a few registers. We're going to deal with these, which we typically call the time value of money, TVM registers. We'll deal with the NPV NPV button. We'll deal with the cash flow button, probably deal with the internal rate of return, but not for a few more lectures, the compute button, and clear. If I look around, I think that's pretty much it for now. So those are the ones we're going to deal with. If you type in something incorrectly, this is backspace, and these up and down buttons are useful when we get into some worksheets. So I have the calculator instructions here. If you need them, feel free to come back to them, but I'm not going to spend much time on it here. Essentially, this is just the way to reset your calculator to make sure that you're in the right mode for the things that we're doing. Okay, so just to make sure that you've done it correctly, that you set your calculator upright, you'll see, if we do begin second set, you can see up here that it says BGN, and it continues to say that even once you clear out. So if you do 1 in 10 IY, 0 for the present value, 100 for the payment, hit compute, hit future value, you'll notice it does $110. That's the way you know you're in begin mode, because that $100 payment is assumed to have happened at the beginning of the year, and so a full year worth of interest is accumulated. It's not what we want. We want to set our calculator here back to end mode, clear that, and if we hit compute, future value, you'll see it ends up being $100. And so that's what we want to do for this part. And so that's effectively how I have it set up here in terms of the input screen. We'll do the number, then the button, number, button, number, button, so on and so forth. If there is a value that's here on the bottom, then that is the output from the calculator. The top part here is the inputs, bottom part here is the outputs. And so whether or not I put this compute button on there, you always have to hit it. You hit compute, and then you press the one that's missing. You'll notice one of these numbers is negative, the other one is positive. Because typically the way we think about these things is kind of like a bank account. We think about deposits and withdrawals. We think about putting money into an investment and getting money back from an investment. And so here, it's as if we put $100 into a bank account and we're asking how much money could we take out at the end? What is the current balance? And so because we're in end mode, because we're assuming that the cash flows happen at the end of the year, effectively, the timeline for our problem looks like this. Time 0, time 1, nothing happened here. Nothing happened at time 0. All we did was put $100 into our bank account at time 1. So what is the bank balance at time 1? It's obviously just $100. We haven't waited. We haven't received any interest because the money's only been in there for about a second. So we will need to usually use a negative to represent either an inflow or an outflow, and then the opposite sign will represent the opposite flow. Whichever one you prefer to use is totally fine. It doesn't change the answer at all. Ultimately, it's just important that you keep track of your inflows and your outflows. Okay, so to test whether your calculator is working, you can do this. So essentially, it's just looking at 2 years for the same thing. So what we're going to do is we're going to clear that, hit second, clear TVM. So I usually do that for every problem, because if you don't, you'll end up with some of these numbers getting stuck in here, especially ones that you don't use. So if you had a payment and there's no payment in the next problem, it may still be in there and it'll muddle your result. So usually clear that out. Hit the clear button a few times. 2, n is the number of periods in the problem. 10 is the interest rate. We enter it as a whole number. Now, if it were 10.5%, we would enter the 0.5, but we do not enter it as a decimal. We do not enter it as 0.10 for 10%. So 10, IY, that's interest per year. The present value was 0. We had no balance in our account prior to this first payment. We do $100 payments. This plus minus button is how you switch from positives to negatives. Hit payment, compute, future value, and it gives you $210. And so as you can see, that's the setup we have here. 2 for the N, 10 for the IY, 0 for present value, negative 100 for payment, compute, future value, comes out to be $210. To the extent that your calculator is in beginning mode, it would come out to be 231. So that's just a way of diagnosing to make sure you're in the right modes for everything. Okay, so doing some math now. Let's actually figure out how we're doing these things. Let's evaluate that exchange, that $100 today in exchange for $110 in 1 year. The way we need to do this is by thinking, what is our next best alternative? Essentially, what else could you do with that $100? What is the alternative opportunity that's available to you? Could you invest it at 10%? Could you invest it at 5%, 20%? What is the alternative that's available in the market? So when we think about the return, when we think about the interest rate on some debt or on some investment, when we think about the return that's being demanded, it is a compensation. It is compensating the person who gave them the money. It's compensating them for the cost of waiting. And more than that, it's compensating them both for the cost of waiting and for the alternative opportunities that they did not invest in. So for example, this $100 today in exchange for $110 in the future. If I could find another investment out there that would give me $120, this isn't adequately compensating me for the cost of waiting. I would rather go with the 120 option, and so the return, the percentage gain on this investment, is not sufficient to compensate for the opportunity cost that's out there in the market. Importantly, though, is it the case that we would be indifferent, that we would be equally happy to accept any 20% project relative to any 10% project? That is, if we see something out there in the market for 20% return, is it always better than a 10% return? And the answer is no. And it's not no because there's some fancy math reason. It's simply the fact that the 20% interest project is likely very risky. If it wasn't very risky, then they wouldn't need to compensate you in such a large fashion to offset that risk. By contrast, this 10% project is less risky. If it were riskier, people wouldn't only accept $10 to compensate them for that risk. They would demand more. So a 10% project, a project that returns only 10%, or an investment that only returns 10%, will be treated as much safer and inherently will be much safer based on that assessed cost of capital. Remember, we talked about return and cost of capital being kind of the opposite of one another, or rather two sides of the same coin. From the company's perspective, they know they are a risk. If they know they're a risk and they have some internal assessment of that risk, that to them represents their cost of borrowing. It's the cost for the lack of certainty in that firm's future cash flows, in that firm's future activity. So when we think about what else someone could do with $100, we need to consider, and we will get to risk, we're not there yet, but it's important to talk about. We need to consider somebody's risk preferences So what else would they choose to do with that $100? And then also whether those options are available to them. So we call that generally the opportunity cost of capital. So when we say return, when we say interest rate, we mean the annualized, every interest rate I give you will be annual, unless I say otherwise, percentage gain on the investment. And so here you can see that this returns 10%. We start with $100, we receive 110. That means that we're receiving $10 more than our original investment. 10 as a percentage of 100, which is our original investment, gives us our 10% return. So the amount we receive is 10 over the $100 we have to invest to receive that 10, and so it's a 10% return. Okay, so suppose that your other option, you have this $100, $110 thing, your only other option is to put the $100 in your savings account at your bank and earn 5% interest. Well, what exactly would be the future value of undertaking this potential investment? Well, it would be $100. We'd keep the original money, of course, plus 5% of that money, a 5% interest, a 5% return on our invested capital. So at the end, the future value of this potential investment is $105. So which would you prefer? $105 in 1 year or $110 in 1 year? Well, obviously you'd prefer the 110. So now when we compare these two potential projects, given the risk assessment and the interest rates that you would require to undertake that project, you wouldn't be willing to undergo this particular investment without being paid 10%. This one, you wouldn't be willing to undergo without paying 5%, or rather receiving 5%. So given that, you should say, well, of course, now that I know I can receive 10% on this project and only 5% anywhere else, I will take the 10% project because both that is the interest rate I'm requiring, I'm satisfied with, and it's better than my alternative option. So if we evaluate the deal kind of across time, today, if you take this deal, the 100 for 110, today you give up 100. In fact, I think I can do this. The top, there we go. Top menu won't come down. There we go. Okay. So clearing that up a little bit. Evaluating the deal, if you take this deal, let's put this as negative 100. Because it makes more sense to think of these as outflows. Today, I will lose $100, and in the future, I will gain $110. What you get back from my deal is greater than the future value of what you would get if you put it in the bank. And that's what the textbook, as I said on Tuesday, that's what the textbook calls the NPV decision rule. And what it essentially means, in this case it's the future value, but it's the same concept, is that the value of a certain project exceeds the value of another project. Or within a single one, the value of all of the inflows exceeds all the value of the outflows at the same point in time. Importantly, if we're thinking about this way, we can't compare $100 to 105. We can't compare $100 to 110 because one is in today's dollars and the other is in next year's dollars. So we need to move our cash flows through time in such a way that we can compare them within the same time period. So when we say future value is essentially saying the equivalent value at some future point in time, say in years, of a given amount of cash today. So if we think about a timeline and we're in time 0, say we have $100 today and we want to know how much money we would be indifferent between having today versus 2 years from now. Essentially, what is the equivalent value of $100 2 years from now, we would be indifferent between taking 100 now and whatever this value is in the future. What is that future value of $100? So in other words, if I invested X dollars today, say 100, and it grows at whatever my opportunity cost of capital is, whatever the alternative price is that I could receive, how much is it worth at the end? So to determine that, to determine the future value of a single cash flow, we need, well, the cash flow, and we need the opportunity cost of capital. So we can also calculate future values over multiple year horizons. So what we did here was just over 1 year, but we can do it over 2 years like I have here on the slide. And so the future value of $100 over a 2-year period, let's assume that same 5% savings account option, will simply be $100 plus 5%, that's just next year, but then plus another 5% for the second year. But notice, here it's $100, here it's $100 plus 5%, but in the second year, it's $105 plus 5%. The $5 we earned in year one also grows by 5% when it moves to year two. It's this idea of compound interest. The interest earned in a given year accumulates interest in all of the subsequent years. And so it's not as simple as saying $5 is the interest on 100, so at the end of year two, we'll have 110, 5 from each year. We also need to consider the 5% interest on the $5 we earned in year one. And so you can see that the future value of this cash flow after 2 years slightly exceeds the simple kind of 5% interest on the original value over 2 years. It's greater by about 25 cents, which is that 5% on the $5 of interest earned. Okay, so when we talk about future value, if instead of doing it in kind of this abstract thinking about compounding sort of way, if instead we put some hard figures to it, some hard theoretical figures, this is essentially the way we're going to write these formulas. We are going to say that the future value of a single cash flow, the present value, the future value after the certain number of periods is equal to the present value today times 1 plus the interest rate raised to the number of periods. So using our last example, we would have $100 multiplied by 1 plus 5% compounded twice. Another way to write that would be $100 times 1.05 squared. And as we saw on the previous slide, that's exactly what we did. We had $100 multiplied by 1 plus the interest rate squared. And that's the general formula for it. That's the idea of moving a present value single cash flow into the future in periods. Now, it's important that the interest rate match the period that you're dealing with. So for example, in this question, we're dealing with 5% annual interest, and we're dealing with annual periods, years. But if this interest rate were annual and we were worried about, say, 18 months, then we would need to do some math to adjust that, and we will see how to do that shortly. For the future value interest factor then, which we talked about a few slides ago, that you can take your present value, multiply it by your future value interest factor to get your future value. Well, now we know that's just this part. That's just the part we're multiplying against the present value. And so it's just 1 plus the interest rate raised to the number of periods. So we could write the future value after some number of periods as the present value multiplied by that interest factor. Now you'll notice the interest factor is a function of 2 variables, not just the number of periods. It is the function of the interest rate and the number of periods that interest rate will apply. Now notice we're not making any assumptions about risk still. We're just kind of saying the opportunity cost. We're using I, same concept as that R subscript F thing that we saw in the previous slide. For now, the notation's not super important. Just think about an interest rate. Once we start talking about the difference between the various interest rates that might apply, then we're going to worry a little more about notation. But these are all the different ways you could see it. Now, this was the previous example. We had this $100. We earned $5 by waiting a year, and we earned $5.25 by waiting the second year. In the first year, it was just that 5% interest on the original amount. In the second year, though, it was both the $5 on the original amount, 5% on the original amount invested, which was $5, but also 5% on year one's interest. This $5 also receives 5% during that second year period. So that's just compound interest. To the extent that you've never heard the idea of compound interest, the alternative would be if this second part didn't exist. If the second part didn't exist, then the interest that we earned in the first year wouldn't accumulate any interest in the second year. Equivalently, you can think of it like this, where we have times 0, 1, and 2. Today, we invest $100, and we take out $5 in year one. So now, we would have had $100 at this point. We would have had $105 at the end of year one, but we subtract $5 out. Then only $100 moves forward into the future, at which point we have $105 again. Assume we take out the 5 there. It leaves us with a $100 invested amount and $10 worth of interest that we've withdrawn. So how much is our wealth? $100 worth of investment plus $10 worth of interest. So we'd only have $120 total. That's how simple interest works. When we call it simple interest, it just means assume we withdraw all of the earned interest each year. We're not going to deal with that pretty much ever. We're almost always going to deal with compound interest. And the reason being is that's how most investments work. If you imagine investing in your 401k or any investment account that you might have through work, essentially, any growth that occurs within that year is then grown again in the following year. So any interest that you earn grows interest as well. And so the simple interest is just the original principal amount times the interest rate. And the compound interest is the interest on interest. It's the return you receive on the growth since the last year. And so we can see this kind of thing happen with a single cash flow. Let's assume we deposit $1,000 at time 0. $1,000 goes into the account. Well, after 1 year at 12%, we would have a balance of $1,120. That's as simple as saying, remember our future value interest factor is equal to 1 plus the interest rate raised to the number of periods. Well, what is the future value of $1,000 at 12% after 1 year? Well, it is 1,000 times 1 plus 12%. That was a terrible 2. Let's do this. There we go. 12% raised to the 1. We're just waiting 1 period. So 1,000 multiplied by 1.12 gives us 1,120. But you'll notice that the following year is not simply $120 more. If that were the case, if it were just simple interest, we would have had 1,120 plus 120, which would have given us 1,240. But you'll notice we have about $14.40 more. And that $14.40 comes from a 12% interest rate applied to the $120 of interest earned after the first year. 12% of that 120 is going to give us the 1440. And again, you can see that after period 2, it grows again in period 3, period 4, period 5. what would the amount have been in year 5 under simple interest? Under simple interest, we could calculate it as just the original 1,000 times 12% would give us $120 times 5 would just be $600. So the original simple interest calculation would give us 1,000 of investment plus 600 of interest, which would leave us just $1,600 in our account. By contrast, this idea of compound interest gives us a balance at the end of $1,762.34. So the amount we can withdraw at the end of 5 years of compound interest is significantly larger than the amount of simple interest. And so this is kind of the calculation that I showed you a second ago. Remember that the future value of something is equal to the present value times the future value interest factor at a given interest rate for a fixed number of periods. Well, we want the future value after 5 years, which is going to be equal to the present value, here that's the $1,000, times 1 plus the interest rate, 12%, raised to the number of periods. Essentially, times 1.12 to the 5th power. And you can see it written here on the slide. The future value interest factor at 12% for 5 periods is 1.12 raised to the 5th. The interest factor that pops out is about 1.76. If we multiply 1,000 by 1.76234, that's the full number, it gives you $1,762.34, which, as you will remember, is the amount that we had here on the bottom of the previous slide. Okay, so why do we care about this? Well, this is essentially the basis of valuing anything. To the extent that we want to value future cash flows in a potential project, we need to do these exact sort of calculations so that we can compare all of the values of the potential projects on the same date. So now, if we were looking at various projects that all paid out in year 5, now we know the value of this particular project in year 5, and we can compare it against all of the other projects of similar value. So this is kind of how it works for this. And I realize for anybody who understands compound interest, this might be excruciating. But if this is your first time seeing it, I want to be very careful about how we talk about this because everything we do relies on this concept. So I apologize if you already know it. Please bear with us. I promise we will do some more interesting things as time goes on. But in year 0, we've invested $1,000 in our bank account. After year 1, we have a bank account of $1,120. We've earned $120 worth of interest. At year 2, we have a bank account of $1,254.40, which includes this $120 of interest, another $120 of interest on the original amount, and $14.40 of interest on interest. You'll notice that it happens over and over again, that the interest on interest accumulates, and by the end, we have $162.34 worth of interest that would not have accrued under a simple interest calculation. Effectively, if we'd never invested this money, even if we found a 12% value every year, other projects, other possible venues, if we used that $120 of interest that we received at the end of the first year, if we hadn't saved it, we would have foregone an extra $162.34. This is why people talk about saving early for retirement, because over time, over even just a 5-year time series, we've achieved another 16% on top of the 12% that we've been receiving each year on the original investment. In just 5 years, there's an extra 16% worth of value. And so that's what this slide was intending to show. So this is the power of compounding interest. You can see that if we just put $1,000 in a bank account and made no money, it would be worth $1,000 forever. If we just did simple interest, we'd only achieve about that much extra value, the interest on the original 1,000. That's just adding that 120, here it's 10%, not 12%, but same concept. It's just adding $100 each period. And so at the end of 20 years, all we have is an extra, was that 3,000? All we have is an extra $2,000 worth of investment savings, which makes sense, right? It's $1,000 times 10% gives you 100 each year, times 20 periods gives you $2,000 worth of extra investment interest. But on that $2,000 that is accumulated over this 20-year time series, there's interest on interest. And that's this kind of dark tealish color here. If you notice, the value of the account, if we just kind of draw a line over, is almost $7,000. In fact, given what we've learned now, we don't have to guess what that line is. Instead, we can use the formula we've come up with. The future value is equal to the present value times the future value interest factor for a given interest rate and a number of periods. We'll take the $1,000 worth of value and multiply it by 1 plus 10% raised to the 20th. And so now, if we flip back over to our calculator, 1.10, the exponent button is here. Click that, raise it to the 20th, and then multiply by the original $1,000 of present value, gives us about $6,727.50. So if we think about this number that we're looking at is about right. It's $6,700 instead of $7,000, it's just below it. That's if you wanted to do these calculations manually. And I think the next couple slides show you how to do it on the calculator, but I'm going to use this example as a way to do it. So we know our N is 20. Our number of periods that we're compounding is 20. The interest rate that we've assumed here is 10. The amount that we've put into the account at the beginning is $1,000. I'm going to put it as an outflow. Imagine putting it into our account. We don't have it in our hands. There are no additional payments. There are no deposits. We're not withdrawing anything. We're not putting any additional money in. It's just sitting there and growing. So we put 0 for the payment, hit compute, hit future value, and you can see that it does the math for us. We don't really need to think too hard about doing future value interest factors or anything like that. In fact, if a question were to ask you, what is the future value interest factor? You don't even need to do the math to solve for it. You could do this calculation here in your calculator, take the future value, and just divide it by the original present value, and you get back to your future value interest factor. Saying that slightly differently, if you've already got the future value and you know your present value, you can solve for the interest factor without having to do any exponents. You just divide both sides by the future value interest, you divide both sides by the present value. Okay, so future values, what we've talked about up until this point, move cash forward in time. We have today cash, we're making future cash. Present values, probably going to use these a little more often than future values if I'm being perfectly honest. Present values move cash backward in time. It takes future cash and determines the current value of it. And just from like a conceptual perspective, if you think about whether we care about what something's worth 10 years from now, or if we think about assessing the value of various projects today, it makes a little more sense to do them today, right? So the present value, very, very similar to the future value, is the equivalent value today, instead of in the future, of a given amount of dollars to be paid or received in the future, as opposed to today. Another way of saying this is, how much would I have to invest today to generate a given amount of money in the future? So if I say there's going to be $1,762.34 in the future at a 12% interest rate, how much do I need to put into my savings account to achieve that balance? And the answer is $1,000. We know that already because we did this problem, but we can solve for that using the present value methodology. But before we do anything more complicated, let's go back to our basic example. Give me $100 today for $110 in the future. Under the best alternative, same facts as we had before, the 5% interest rate, how much would I need to invest today to generate this $110? If it's $100, then okay, I'll take it. All right. So, kind of going back to first principles, this is the calculation that I show you guys at the end of the introductory slide deck, the topic 1 stuff. We know that we have some present value that we need to solve for. We know that we'll invest it at 5% for 1 year. And we know that at the end we want $110. Well, if we divide both sides by this, we can solve for $104.76. In other words, under the best alternative, I would need almost $105 to get this same payoff. Here, I'm only being required to invest $100, which is less than $104.76. I will have, assuming I have both of these quantities, I would be able to put this $4.76 to some other use and would still receive the same $110 payout. So the present value of $110 at 5% to be received 1 year from today, the present value is $104.76. So let's go back. If you take my deal, today you pay me $100, and in the next year I pay you $110. If you invested it in the bank, you pay them, let's say 105, so I don't have to keep saying the decimals. You pay them essentially $105, and next year they pay you $110. It's pretty obvious which one's the better deal, right? But if you had just asked me this part, it might have been a little more complicated. Which one's better, $100 and then $110, but then I could put it in the bank, and that's 5%. Which one costs more? Obviously, if you're good with math, it's pretty clear. But just when these numbers get more complicated, longer time series, you can imagine these things get tricky pretty quickly. So let's compare the two. Deal I offered, cheap way of producing the same future cash benefit, so it's a good deal. It is cheaper, and I get the same output. The present value of the future benefit, that 110, at my current opportunity cost of capital, my other potential investments, the present value of that future benefit is actually $104. It's greater. The present value of those cash flows is greater today than the cost I'm asking you to put in. And so again, it's a good deal. So when we're dealing with present value over multiple years, we can do the same thing we did before. Remember I showed you guys this formula. I know it was 2 seconds ago, but I'm going to say it as if it's new. I said that the future value is equal to the present value times the future value interest factor, right? Well, I have a new thing to tell you. The present value is equal to the future value times the present value interest factor. Ta-da! So essentially the idea here is that we can switch between these two pretty seamlessly, right? But if future value and future value and present value are the same numbers, then how do I write these two things in terms of one another? Well, let's see. Future value equals the present value times the future value interest factor. What happens if I divide both sides by the future value interest factor? In fact, let's call it FV times 1 over the future value interest factor equals the present value. Well, look, present value, future value, but this is the present value interest factor. So when we're doing the present value of something, it's just the opposite of taking the future value of the same thing. It's the reciprocal. So to show that a little more explicitly, let's imagine we say the future value of $100 at 10% over 2 years, well, okay, that's some number. But what if instead I said, okay, well, that's 121 bucks. Pretend I don't have this information for a second. I have $121 today. I want to solve for the present value. I know I can invest my current money at 10% for 2 periods. How much do I need to stick in to get $121 in the future? Divide both sides by 1 plus 10% squared. Well, notice what's over here now. It's 121 times 1 over 1 plus the interest rate raised to the number of periods. Instead of compounding, now we're doing what we're going to call discounting. We're moving things backward in time instead of compounding them forward in time. Let me clear this here so you can see the actual parts of the slide. So you can see that if we have the future value, the 110 in the future, we can discount back to present day using the opposite technique of that compounding we showed in the previous slides. So we're dividing it by that interest factor instead of multiplying it by the same thing, and all we've done is call it a future value or a present value interest factor instead of the opposite. All we're doing is dividing instead of multiplying. So if we take $110, divide it by 1 plus the interest rate raised to the number of periods, we can solve for the present value of that cash flow. So the present value of 110 bucks to be received here 2 years from today, we don't just do it at the first power, we do it to the second power. We've taken the $110 and gone back 2 periods in time. Effectively, if we think about a timeline here, I always draw timelines for every time value of money problem I do. If we want $110 at time 2, how much do we invest in time 0? Or asked differently, what amount do I need to put in at time 0 so that after 2 periods of compounding, I have $110 at the end? Easiest way to solve for that, divide by 1 plus the interest rate squared. Or in this case, because it's 2 years, it's squared. 1 plus the interest rate raised to the number of periods. Okay, so why do we care about present value? As we talked about in the previous deck, present value is used to value assets. Any financial decision anywhere involves kind of buying, selling, trading various things of value. And assets here, I'm not thinking in the formal accounting definition, just generally they're things that represent value. They represent future cash flows. So if we think of an asset, just abstract away completely. Don't think about, a building or a piece of machinery. It's a box. It's something that the company uses productively to generate future cash flows. Now, the individual aspects matter, and those are useful in determining the cash flow sequence, but once we've figured out what the expected cash flows of the opportunity are, it doesn't matter if it's investing in new real estate or starting a new product line. Ultimately, it's just a series of cash flows. So, if we think of an asset in that way, where it's just a sequence of current and future cash flows, then we'll think of an asset as, at a given time period, we'll think of the value of that asset at time t, as the value of the cash flow at t, plus the cash flow at t plus 1, the cash flow at t plus 2, cash flow at t plus 3, and so on and so forth. So to value this asset, what we want to do is figure out the value of the asset at time t, which for now, let's call it t equals 0. Let's make it today. So an example of something that might work that way, let's say a manufacturing facility. Let's say we just started. Well, the asset today is not going to generate anything, let's just assume. And then tomorrow it generates 100 bucks, then it generates 120 bucks, then it generates 200 bucks, then it actually loses us $50. Well, how much is it worth? Well, we could add these things up and we'd get a fairly naive estimate. We could compound it all into future value, but that's not the value today. What we want to determine is how much should we pay for this type of an asset. Assume we haven't bought it yet. Assume we have it invested in the project. Well, effectively what we need to do is determine the value of this cash flow today, this cash flow today, this cash flow today, and even this cash flow. Add it all up, and that is the present value of all of those cash flows. And the present value here, remember, tells you the value you should be indifferent between giving up, between the current value and that future cash flow stream. You're determining the present value, the value you would be willing to buy this cash flow stream at, what the price would be. Okay, so now if we think of assets in this way, we can value any asset we want using present value. And that's how it's done. I mean, realistically, that's how market values are calculated. The market value of a given asset is determined as what an investor would be willing to pay for it today, given the sequence of cash flows that are expected to pay out, and given the assessment of the risk of that project, which determines the interest rate. So this is essentially saying that you should be willing to pay the equivalent value in today's dollars of all of the cash flows that that asset will produce, given the expected level of risk that we have. The market value of the asset then is simply the sum of the present values of all of the asset's current and future cash flows. Now it says the present value of the current cash flow, and that's not wrong, it might be a little overstated. So remember that the present value of something is equal to the future value of that something times the present value interest factor at some interest rate, some number of periods. Well, if the future value is already today, so it's already a current cash flow, then the number of periods that we need to discount it back is 0. So let's say it's $100 cash flow times 1 plus 10%. But remember, we raise it to the number of periods. Here we'll raise it to the 0. Well, 0 periods, it's not moving anywhere. It's not doing anything. And if you remember your algebra, any number raised to the 0th power is just equal to 1. So it becomes 100 multiplied by 1 equals 100. It's still the present value calculation. It just doesn't do anything. It's the same number before and after. Okay? So the way we're going to value an asset using this framework, we need to define the sequence of cash flows. And for a finance class, we're going to just assume that kind of already happened. But in the real world, this is where 99% of the effort takes place. That's not a 4, that's a 9. 99% of the effort takes place in this part. Because this is where the business stuff happens. This is where marketing happens and strategy and logistics. Finance just takes those and converts them into a price. So we're going to convert each future cash flow to today by taking its present value. Then we're just going to add up all those present values, and the value of that asset, that's what the V is here. The value at 0, you could also do price at 0 if you preferred, is going to be equal to the cash flow at time 0, the current cash flow. And you'll notice it doesn't get wrapped in a present value function. It doesn't get wrapped in anything because it's already being discounted by nothing. It's being multiplied by nothing. The second part here, the present value of the cash flow at time 1. Well, the cash flow at time 1 times 1 over 1 plus the interest rate raised to the number of periods. Well, if it's 0, this is still just 1. Well, here we've got a 2. Here we've got a 1. There's actually some effect of this present value calculation, right? So using this present value calculation on cash flow 1 actually does something, because it divides the cash flow at time 1 by 1 plus the interest rate. The cash flow at time 2 gets divided by 1 plus the interest rate squared, and so on and so forth. So as we go farther into the future, say cash flow at time 99, this cash flow will be discounted back so far by such a large denominator that it won't be worth nearly as much as a cash flow in time 1, even if they're the same value. And that shouldn't be surprising. That's essentially saying $100 today is worth more than $100 at time 1. Both of those are worth a lot more than waiting almost 100 years for the same value. So in our simple example earlier, effectively I'm offering to sell you some cash flow, an asset, that pays $110 next year. And that $110 payout, we're determining the price for it. What is the fair value of that asset? Well, turns out you could value it given your opportunity cost of capital, given your alternative potential return, whatever outside option you have. Well, the fair value to you of that asset is just the present value of those future cash flows. Well, the future cash flow is just $110. We discount it back just the one period because it's just next year. We determined that the price a minute ago when we did the present value calculation, the price should be $104.76. I'm offering to sell you an asset that's really worth $104, but I'm only selling it to you for $100. And so you can see that this is a good deal, that this is actually a project or an undertaking or a purchase you should make. So with the present value, I just realized a second ago, so apologies. I realized whenever I showed you guys the x to the 0 equals 1 thing, I did the present value equals the future value times the present value interest factor, but then I did it as multiplied by 1 plus the interest rate. That's not correct. It should be 1 over 1 plus the interest rate. So I apologize. I just realized that I made that mistake. But we'll do that correctly here. The present value at a time period is equal to the future value at some future time period multiplied by 1 over 1 plus the interest rate, with that whole thing raised to the number of compound or discounting periods, the number of periods we're moving it across time. This chunk is then going to be called the present value interest factor. This is no different than when we did the future value at time n is equal to the present value times the future value interest factor. This thing was just divided or defined as 1 plus the interest rate raised to the number of periods. The present value interest factor, as I showed you guys a few minutes ago, is just 1 over 1 plus the interest rate raised to the number of periods. And that's what you have here. So it's just a simple manipulation of the same concept. All we're doing is instead of compounding, we're reversing that compounding, and we typically call that discounting. So same sort of idea that we saw with the future value. If you're taking the present value of a single cash flow, we're taking, say, $1,000 at time 5 and figuring out how much we would need to invest today to have a balance of $1,000 in 5 years. Here, assuming we have a 12% interest rate. And if we do our discounting correctly, we could do the math, or we could use a financial calculator to do it. We can determine what amount we need to invest in that account that returns 12% each year so that we have $1,000 in 5 years. Now, if we do it by hand, we do the math by hand, we take the $1,000 and multiply it by 1 over 1 plus the interest rate, against 12%, raised to the number of discounting periods. Again, when we're moving forward in time, future value we call compounding. When we're moving back in time, we call it discounting. So here it's 1,000 multiplied by 1 over 1 plus the interest rate raised to the number of periods. Remember, this thing is our present value interest factor at a given interest rate for a number of time periods. So our present value interest factor at 12% for 5 periods is this part, 1 over 1 plus the interest rate to the 5th power. Gives us a factor of 0.56743. Some classes actually do more at the undergraduate level. Some of them will give you present value interest factor tables. And so you go across to the interest rate and then you go down to the number of periods, and this number would be on the table. I think we can handle a little division. So given that you guys will have a calculator, I think this is within a reasonable realm. And I think using the tables is a little unhelpful. I think it's useful to see the calculation and to understand how this is really just the reciprocal of multiplying by the compounding factor. So we've got the $1,000 future value. We're discounting it back 5 periods at 12% to get that present value, and that value is $567.43. Let's do it on a calculator instead. Let's do that. Okay, so again, I want to make sure my time value of money registers are clear, because if I hit this recall button and then I hit my present value, you'll see there's a number baked in there, and I don't want that. So what I want to do is go second, clear time value of money. Now if we do recall present value, it should be empty. Good. So now our problem is 5 periods of discounting at 12%. So let's go 5 in 12 IY. We don't have any new deposits or withdrawals, so our payment's 0. And we know we want to have $1,000 in the account in the future. So the future value is 1,000. Hit compute, hit present value, and you can see that 567.42 that we just saw. Here it's 43, but if you round the 426 here, it goes to 43. And that's all this slide's showing you. 5N, 12IY, 0 payment. Here I have it as negative because it's like a withdrawal, but again, as long as you keep your signs consistent, you can do whichever one you prefer. So put that in for the future value register, and then we'll hit compute, present value, and 567.43 pops out. So when we think about present value, it works kind of the opposite of the future value calculation we did before. So if you think about the future value chart where we had the kind of time series here and we said like this part was just $1,000 and then there was this little bit of interest on the $1,000 and then there was this interest on interest component. Well, all we're doing here is flipping the chart to where now it looks like this. Effectively, what we're showing is the effect of discounting. If we have $1 in present, if we have $1 that we have in the future, and we're calculating the present value of that dollar over 10 discounting periods. Blech. Okay, $1 in the future, discounting it back 10 periods at various interest rates. The present value that results, well, if it's a 0% interest, it's just $1. We didn't discount it at all. It was 100 multiplied by 1 over 1 plus 0% raised to some number, which if you do 1 over 1, it's just 1. And 1 cubed, 1 to the 4th, 1 to the 99th, all equal to 1. So we still end up with $100 at the end. So here, if we put in $1, our interest rate 0, nothing happens. Essentially, if our outside option, if we don't have any potential to invest our money in anything, then the value of money across time is essentially the same. But here, at even just a 5% interest rate, at a 5% interest rate, investing $1, $1 10 years in the future, $1 10 years in the future, the present value of receiving $1 10 years in the future, if your current outside option is 5%. That's what I mean to say. So $1, 10 years in the future, 5% is the interest rate. You would only be willing to pay just over 60 cents for that future cash flow. At 10%, you would barely be willing to pay 40 cents. At 15%, you're almost down to 20. So as the interest rate grows larger, a future cash flow is worth less today. And that makes sense because remember, our interest rates are a version of risk. So imagine that you've got a very risky project, a 15% interest rate project. It's very risky. Well, the risk of that cash flow is high, and the farther it is in the future, the longer it is I have to wait until I find out if it was worthless or not. So I'm not willing to pay very much today, in fact, very little, today for a very risky cash flow a really long time in the future. But you'll notice this line is always below the others. So the 15%, the high risk aspect, makes me less likely to pay for it regardless of how far it is in the future. And the number of discounting periods also makes me less likely to pay for it. The longer I have to wait, the less I'm willing to pay for something regardless of how much the risk changes. So high risk, low risk, I don't want to wait 10 years for my money. So I'm going to pay less today for a thing that happens in the future, regardless really of what my interest rate is, as long as it's non-zero. And so this is the point I made a minute ago, which is essentially, if you've got a present value interest factor, it's the same as 1 over the future value interest factor. And if you've got a future value interest factor, it's 1 over the present value. Because taking $100 and determining the value in the future, one period, gives us 110, is essentially the same mechanism as taking that 110 and trying to figure out what the value is today. It's just instead of multiplying, we divide. So now we're going to talk about cash flow sequences. So for cash flow sequences, we know how to calculate these present and future values of single cash flows now, right? And that's great. What we've done is essentially a single cash flow at some point in time, and we've valued it some number of periods either before or after that cash flow occurs. But no asset really pays just a single cash flow. I mean, there are a few. But realistically, when we think of big corporate projects, we think of cash flows that happen multiple times. We think of sequences of cash flows. Invest in a project or a company or any sort of stock or bond, there will be several cash flows that occur at various points in time. And if we want to value an asset that has that kind of characteristic, then we need to calculate the present value of that entire stream of cash flows. And there are 3 sort of fundamental types. There's an irregular cash flow sequence, which we need to discount the individual flows back manually, or we can use our calculator. An annuity, which is the same payment multiple times for a fixed term, so 10 payments of $100, or perpetuities, which are $100 payments forever. There's no fixed term, but the payment's always the same. We can tweak that a little, and we can even make that perpetuity grow at a constant rate, but that just requires a slight adjustment of the kind of idea of the same payment forever. So it's not any more complicated, it's just a slightly different formula. So what we're going to do in this next chunk is take this single cash flow idea and apply it to assets that are slightly more complicated. So if we think back to this picture, debt capital, equity capital, real investments. If we treat these all as a class of asset, and if we say we want the value of that asset at time 0, and if we agree that the value at time 0 is the present value of the cash flow at time 0, cash flow at time 1, cash flow at time 2, then doing a simple discounting of those future cash flows back to time 0 is exactly what we need to do to price that asset. So if we think of it slightly differently, let's think of a corporation as having invested capital and returning future cash flow. In other words, debt capital, borrowing on a loan, we will have some amount of money that was invested in us. From the investor's perspective, that's the outflow. For our perspective, it's the inflow. The investor will then receive future cash flows. How much should they invest in us given the expected sequence of future cash flows that they could receive? Similarly, a stockholder, if they invest money in us, how much should they invest given the expected sequence of future cash flows that they plan to receive? For a corporation, operating cash flows will come off of various projects that we undertake. What price should we be willing to pay to invest in those future cash flow sequences? That's what we're going to do. So the timeline thing here is going to be really helpful because it's useful to be able to track when the individual cash flows occur. It's easier if you just say, well, it was in time 4 and it was a single value. But when we have different values at each time frame, it takes a little bit more math. So here we've got a timeline where it's $100, single cash flow, received at time period 3. We've already done math where we could say, well, what's the present value of this thing after 3 periods? Or we could say, what's the future value in time 4? All of that's easy enough, right? If we wanted time 4, we would do 1 plus the interest rate raised to the first, because we're just moving it forward 1 period. If we wanted the value as of time 0, we would take that $100, divide it by 1 plus the interest rate raised to the third power, because we discount it back 3 periods. So that's what we've done up to now. But what if we had a timeline like this? Here we have a payment of $100 for individual times. We're going to call this a regular or an ordinary annuity. An annuity just means it's the same payment multiple times, same periodicity. So each one happens once a period, and it's the same amount. Regular here, as we talked about on Tuesday, is that the first payment occurs at the end of the first period. A regular or an ordinary annuity, first payment happens at the end of time 1. An annuity due just means it happens at time 0. So there's an instant cash flow in addition to all of the subsequent cash flows. So a 4-year annuity due, the cash flow happens at time 0, 1, 2, and 3. There is no cash flow at time 4. By contrast, an ordinary annuity, there's no cash flow up front, but there's a cash flow at time 4. We won't do too much with annuities due, but I did want to kind of point out that they exist. A lot of my old practice exam problems do have those in there. You're welcome to use them to practice. Ultimately, if you think of it as a timeline where you don't put numbers, so let's just say there are tick marks. If I have 100 here, 100 here, 100 here, and 100 here, it doesn't really matter. If we wanted to figure out the value of that cash flow sequence here or here, it doesn't really matter whether it's a regular annuity or an annuity due. All we're doing is discounting this one back 1, 2, 3, 4 periods, or discounting back 1, 2, 3 periods. Ultimately, it doesn't really matter too much as long as we know where on the timeline we fall. If we call this time 0, or if we call this time 0, we call it this one or this one, all that changes is how many periods we're discounting each cash flow. Okay, so this is more realistic of what a project might actually look like. So this is a timeline of, we've got an initial outflow, some sort of investment, and then we've got cash flows that come from that project over time. And what we would ask ourselves with a timeline like this is, well, should we take the project? And the question would be, is the interest rate high enough or low enough such that this project is a good idea? So now we need to actually value those. And the way we're going to do this, unfortunately, with a complex series of cash flows like this, complex here meaning that they're not all $100. That would be an annuity, or if it was $100 into infinity, then that's a perpetuity. This is complex because 100 and 75 and 50, they're not the same value. And they're not growing or decreasing by a given rate. You'll notice this one decreases twice and then goes up to 60. So there's no constant growth, there's no constant reduction that we can take advantage of mathematically. So the only way we can really do this is to add up, that's what the summation thing is here, add up the individual cash flows that we've moved through time. Now, here it starts with the future value. Future value, present value, we now know there's not a meaningful difference. It's just moving cash flows through time using interest factors. But we'll start with the future value so we can see what the total cumulative value is in the future. And all we need to do is take the cash flows at a given time and compound them forward a bit. You'll notice that there's capital T minus T here. So future value at, say, time 5, capital T, we'll need to take the cash flow at, say, little t, time 1, and compound it forward 4 periods. Think about a timeline. 0, 1, 2, 3, 4, 5. If there's a cash flow at time 1, and we want the future value as of time 5, we need to move it forward 1, 2, 3, 4 periods. So the cash flow at little t equals 1 gets multiplied by 1 plus the interest rate. Capital T is 5, little t is 1, so it gets raised to the 4th. That's all that's doing. It's essentially the way you write it out as a formula, but in reality, I doubt you're ever going to write this out. It'll be much more just kind of running right with the calculations. So if we have something like this, what is the future value of this complex cash flow as of time 4 if the interest, aka the compounding rate, is 6%? So what we want to do is move cash flow 1 3 periods into the future at 6%. We want to move cash flow 2 2 periods into the future at 6%. And we want to move cash flow 3 1 period into the future at 6%. And then the cash flow at 4 doesn't need to go anywhere because it's already home. So how do we do it? We do 100 times 1 plus 6% raised to the first, so to the 1, gives us, oh, these are the present values. This is what I'm after. I hit forward too many times. Sorry about that. This is the future value. Okay, so the future value here, $100 gets compounded forward 3 times to go to time 4. I didn't mean to put the 1 there. Sorry about that. Okay, so this is the future value calculation. I accidentally hit the forward button too many times. They look too similar. Okay, so the cash flow here, $100 goes forward 3 times to get to time 4, right? That's our timeline here, 0, 1, 2, 3, 4, 1, 2, 3, 4. Our cash flow at time 1 needs to go forward 3 full periods. So we'll multiply it by 1 plus 6% raised to the third. So that 1 plus 6% raised to the third will increase. This is a number greater than 1. We'll increase that $100 cash flow in time 1, and we'll see the future value is about $119. The 125 in time 2 gets compounded forward 2 periods at 6%, comes out to be $140.45. The $200 only gets compounded forward 1 period at 6%, comes out to be $212. And the cash flow at time 4 is $300. It doesn't go anywhere. It stays $300. Add up the future value of all of those cash flows, and you end up with a price in the future at time 4 of $771.55. That's the future value of a series of complex cash flows. Now here's the present value. I don't know what this little line is. So the present value at capital T works very similarly. Just instead of multiplying by 1 plus the interest rate, you're dividing by 1 plus the interest rate raised to the number of periods. So all we're going to do is take each cash flow and discount it back. Then we'll add the present values together. This will give us the price today for that series of complex cash flows. So there we go. When you're using the pen, the touch screen gets a little wonky with your finger. So it always advances it instead of lets me access the menu. Sorry about that. Okay, so the present value here, this is the $100, $125, $200, $300, same cash flows we had before, but now instead of compounding them forward, we're going to discount them back. Now you'll notice that all of the cash flows have to move now. Whereas when we were calculating the future value, 1 went forward 3 times, 2 goes forward the twice, 3 goes forward 1 time, and 4 just stays where it was. Now we need to take 1 back 1 period, 2 back 2 periods, 3 back 3 periods, and 4 back 4 periods. All again at 6%. So clear those markings. Now we're going to divide by 1 plus 6% raised, not 1, to the first. So here, this $100 is being discounted back 1 period at 6%. 1 over 1 plus 6% to the first is a value less than 1. The denominator is greater than 1. 1 divided by a number greater than 1 will give you a number less than 1. So $100 being multiplied by a decimal means our present value is, of course, going to be smaller than our future value. That's another way of saying we're not willing to pay full price for a cash flow in the future. Instead, we're willing to pay a slightly discounted price based on what our opportunity cost of capital is, that 6%. So that $100 discounted back one period ends up $94.34. 125 divided by 1 plus 6%, here it's squared because we're going back 2 periods to times 0, gives us 111.25. Do the same thing for cash flows 3 and 4. These are the present value of each of the cash flows. Equivalently, if I told you I will offer you $100 at one period in the future, how much will you pay me? Your answer would be $94.34. If I told you I'll give you $125 2 years from now, how much will you pay me for it? You would tell me $111.25. If I told you I'll pay you $200 3 years from now,